No siren, no warning, no alert on your phone. Splitting open, hundreds of missiles, all at once. And here's what nobody is telling you. This wasn't chaos. This was engineered. Every target, every timing, every direction, calculated. And the most dangerous part, it's not what happened last night. It's what Iran has already planned for tonight. Welcome, my dear friends, to Currency Archives. Now, before we go any further, if you've been with us before, you already know we don't do surface level news here. We go deep. So if you haven't subscribed yet, think of it this way. Your grandchildren will one day ask you, did you see this coming? Make sure the answer is yes. Hit that subscribe button. It takes 1 second. And tell us in the comments, where in the world are you watching this from tonight? We read every single one. Now, let's get into what really happened. It began with silence. Not the comfortable silence of an ordinary night, but the kind of silence that comes just before everything changes. No siren, no emergency alert, no warning of any kind. The people of Israel went to sleep, believing that the systems built to protect them were watching, were ready, were working. They were wrong. At midnight, when human alertness is at its lowest, when defense crews operate on minimum staffing, when reaction times are slowest, Iran launched. And what they launched was not a simple missile strike. What they launched was a carefully engineered trap. Military analysts studying the footage are calling it one of the most tactically sophisticated strikes in modern Middle Eastern conflict history. Here is what actually happened, and why it matters far beyond the battlefield. Iran fired cluster missiles, timed for midnight, aimed at Israeli airspace. Israel's radar system detected an incoming threat. One missile, one signal, one target. Standard defense protocol activated immediately. The system committed its response, calculated its intercept trajectory, and prepared to neutralize the threat. Then something happened that the defense system was never designed to handle. The missile opened. Mid-flight, at a calculated altitude, the single missile separated into hundreds of individual warheads, each one independently targeting a different location, buildings, infrastructure, areas where Israeli military and intelligence operations are concentrated. By the time the split occurred, Israel's defense response had already been committed to stopping one projectile. There was nothing left to redirect, nothing left to intercept. The submunitions fell. This is not a story about brute force. This is a story about precision manipulation of a defense system's own logic, turned against itself. Iran did not overpower Israel's defenses. Iran outsmarted them. And for any serious analyst watching global security and economics, that distinction is everything. But Iran did not act alone. For the first time since this conflict entered its current phase, Iran and Hezbollah launched simultaneously, coordinated, synchronized, hitting Israel from two directions at the exact same moment. From the north, Hezbollah rockets struck areas that had not seen this intensity of bombardment in months. Communities, infrastructure corridors, and supply routes that had quietly resumed some degree of normal economic activity suddenly found themselves under fire again. From the east, Iran's cluster payloads struck targets across central and southern Israel. Two fronts, one night. The people caught between them had no functioning early warning system to tell them what was coming. In the hours that followed, something happened that military observers found more alarming than the attack itself. Israel's own government acknowledged publicly that its alert system is not functioning properly. The Iron Dome network, the radar infrastructure that Israel and its allies had spent decades building and billions of dollars funding, has been degraded. According to analysts reviewing satellite imagery and government statements, somewhere between 25 and 30% of Israel's radar network is no longer reliably operational. The country that designed and exported civil defense architecture to nations across the world was now telling its own citizens that the architecture protecting them is broken. That single admission carries consequences that stretch far beyond Israel's borders. Because when a nation with Israel's defense reputation publicly acknowledges a structural failure of this magnitude, every government, every military planner, and every serious economist watching this conflict is forced to ask the same question. If this system failed, what else is more fragile than we believed? The attack of that midnight was not simply a military event. It was a signal. It demonstrated that a determined regional power, with the right strategy, can engineer a strike that bypasses one of the world's most sophisticated defense systems without matching it in raw power. For the business community watching this conflict, for the entrepreneur trying to understand what is shifting in the global order, this is where the real story begins. Because what happened in the sky above Israel that night is already moving markets, reshaping supply chains, and forcing decisions in boardrooms and government ministries far from the Middle East. Nobody called it a war plan. They called it escalation. They called it retaliation. They called it regional tension. But here's what serious analysts, the ones not appearing on television, The ones briefing governments and multinational boards behind closed doors are calling it a schedule. Because what Iran is running right now is not a series of emotional reactions to political events. It is not improvised aggression. It is not the chaotic violence of a desperate nation lashing out without direction. What Iran is running is a structured daily campaign, methodical, rotating, deliberately designed so that no single defense system, no single economy, no single government ever gets enough time to fully recover before the next wave arrives. And once a person understands the rotation, they cannot unsee it. The clock. Nobody is watching. Every 24 hours, the cycle runs. Morning. Iran's proxies and allied forces apply pressure to Gulf state infrastructure, oil facilities, energy terminals, the arteries through which a significant portion of the world's petroleum supply flows every single day. The message being sent in the morning hours is not military. It is economic. It is directed at the foundational resource that underwrites the stability of dozens of national economies simultaneously. Afternoon. Attention shifts to Bahrain, Qatar, naval assets moving through the Arabian Sea. These are not random targets. Bahrain hosts the United States Navy's Fifth Fleet. Qatar hosts Al Udeid Air Base, one of the most strategically significant American military installations in the entire Middle East. Striking adjacent to these positions, or striking the naval corridors that supply them, is a message sent not just to small Gulf nations, but directly to Washington. Evening. American military installations across Iraq and the broader Gulf region come under pressure. Drone strikes, rocket attacks, coordinated harassment of bases that serve as the logistical backbone of American power projection in the region. By the time the evening cycle activates, American commanders are already managing the aftermath of the afternoon strikes while simultaneously preparing for what the night will bring. Midnight. Israel. The genius of no recovery. Most people, when they think about military conflict, think about individual battles, one strike, one response, one moment of crisis followed by a period of assessment and recovery. Iran has removed the recovery period entirely. By the time Saudi Arabia's air defense teams have assessed the morning damage and begun their resupply and recalibration, the afternoon wave is already launching from a different direction at a different target. By the time American base commanders in Iraq have filed their incident reports and rotated their alert crews, the evening strikes are already in the air. By the time Israel's degraded radar network has attempted to process the previous night's damage, midnight has arrived again. This is the no recovery window doctrine, and it is not being discussed with the seriousness it deserves in mainstream economic analysis, because the military dimension, as significant as it is only one layer of what this rotation is accomplishing, what the rotation is doing to the economy. Every morning strike on Gulf energy infrastructure sends a signal to oil markets before European trading sessions open. Prices shift, futures contracts reprice. Energy-dependent economies from Germany to Japan to South Korea quietly absorb a cost increase that their populations will feel weeks later at fuel pumps and electricity bills. Every afternoon, strike near Bahrain and Qatar raises the operational risk calculation for shipping companies moving cargo through the Arabian Sea. Insurance premiums adjust, freight rates climb, the goods moving through those corridors, electronics, food commodities, industrial components, become fractionally more expensive with each passing week of sustained pressure. Every evening, strike on American installations forces Washington into a posture that consumes political attention, military resources, and budget allocation, resources that cannot simultaneously be directed elsewhere. And every midnight strike on Israel reminds global markets that the region's most economically integrated conflict zone has no functioning early warning system and no clear timeline for resolution. This is not chaos. This is choreography. The question every serious decision maker must ask when a campaign is this structured, this deliberate, this precisely timed, it means someone planned it far in advance. It means someone studied the recovery cycles of every target's defense system, mapped the economic pressure points of every nation in the rotation, and designed a campaign not to win a single battle, but to make the entire region too exhausted to resist. For the entrepreneur, for the business strategist, for anyone managing assets, supply chains, or long-term investment positions in or near this region, the question is no longer, will this escalate? The question is, how long has it already been escalating without anyone telling you? There's a moment in every major historical conflict when the generals are still counting missiles and the economists are already counting casualties. Not human casualties, economic ones. That moment, for this conflict, has already passed. And most of the world's business community missed it entirely. Not because the signals were not there, not because the data was unavailable, but because the signals arrived quietly, disguised as routine market fluctuations, modest freight adjustments, and minor insurance premium revisions that seemed, individually, too small to alarm anyone. But they were not small. They were the first cracks in something much larger. And those cracks are now spreading. The ocean, nobody is watching. Ask the average entrepreneur where global trade moves, and they will likely gesture vaguely toward the internet, toward digital transactions, toward the invisible networks of modern commerce. But the truth is far older and far more physical than that. Approximately 80% of all global trade by volume still moves on water, on ships, through specific narrow corridors of ocean that have no alternative routes, no backup pathways, no redundancy built into their geography. Two of the most critical corridors on Earth run directly through the crisis zone that Iran's daily rotation is systematically pressuring. The Strait of Hormuz, 17 miles wide at its narrowest point. Approximately 20% of the world's total oil supply passes through it every single day. Every liquefied natural gas shipment from Qatar. Every crude oil tanker from Saudi Arabia and the UAE. Every petroleum product bound for Asia and Europe moves through that 17-mile channel. The Red Sea corridor feeding into the Bab el-Mandeb Strait. Before this conflict intensified, approximately 12% of global trade volume passed through this route annually. Goods moving between Asia and Europe, consumer electronics, agricultural commodities, pharmaceutical supplies, industrial components feeding manufacturing operations across 3 continents. Both corridors are now operating under sustained threat. And the economic consequences of that single fact are already restructuring global commerce in ways that will not fully reveal themselves for another 12 to 18 months. The numbers. Behind the silence, shipping companies do not announce their rerouting decisions with press conferences. They quietly instruct their captains to go around Africa instead. The Cape of Good Hope route, the alternative to the Red Sea corridor, adds approximately 10 to 14 additional days to shipping times between Asia and Europe. It adds thousands of dollars in additional fuel costs per voyage. It strains crew rotation schedules. It delays inventory arrivals at European and American ports. And every one of those additional costs eventually lands on a price tag somewhere. On a shelf, in a warehouse, in a supply chain spreadsheet that a small business owner is staring at, wondering why their input costs have quietly risen 15% over the past several months without any single obvious explanation. This is how geopolitical conflict enters the daily economic life of people who are not watching the news. Not through dramatic announcements, but through slow, steady, invisible pressure on the systems that move goods around the planet. The insurance market is sending the same signal to those paying close enough attention. War risk insurance premiums for vessels operating in the Arabian Gulf and Red Sea have increased substantially since this conflict entered its current phase. Lloyd's of London and competing syndicates are quietly repricing the risk of moving cargo through these waters. Shipping companies absorb some of that cost. They pass the remainder to their customers. Their customers pass it further down the chain. By the time that repriced risk reaches the end consumer, it is unrecognizable as a consequence of missiles fired at midnight over Israel. But it is. The currency. Nobody is discussing. While energy markets and shipping routes absorb the visible pressure, something quieter is happening in global currency markets. The Petrodollar system, the arrangement through which oil is priced and traded globally in United States dollars, creating structural demand for dollar-denominated assets worldwide, is facing a stress test that its architects never anticipated at this particular intensity. When Gulf state energy infrastructure comes under sustained morning pressure in Iran's daily rotation, when oil facility output becomes unreliable, when shipping insurance makes Gulf crude more expensive to transport, the economic logic that underpins petrodollar recycling begins to strain. Gulf sovereign wealth funds, which collectively manage trillions of dollars in assets, are watching this conflict with an attention that their public statements do not fully reflect. Behind closed doors, portfolio managers at funds in Abu Dhabi, Riyadh, and Doha are running scenario analyses that their governments have not authorized them to discuss publicly. The scenario they are most concerned about is not a dramatic dollar collapse. It is something quieter, more gradual, more difficult to reverse. A slow rotation of reserve allocation, away from dollar-denominated assets, toward gold, toward yuan-denominated instruments, toward assets that carry no exposure to a geopolitical conflict, that shows no sign of structured resolution. That rotation, if it accelerates, does not announce itself. It simply happens. And by the time mainstream financial media identifies and names it, the window to respond, for most ordinary investors and business owners, will already be closed. Who is quietly winning? Every disruption creates a loser, but every disruption also creates a winner. And the winners of this particular disruption are not difficult to identify. For anyone willing to follow the capital flows rather than the headlines, Russia, already operating outside Western financial systems following its own conflict, is watching Gulf energy disruption with considerable interest. Every percentage point increase in oil prices driven by Middle Eastern instability adds revenue to Russian energy exports flowing eastward toward Asia. China, which has spent the past decade methodically building alternative trade infrastructure through its Belt and Road Initiative, finds its overland and alternative maritime routes suddenly more attractive to regional partners who are questioning the reliability of traditional sea corridors. India, positioning itself carefully between Western alliances and Eastern partnerships, is quietly expanding its role as a regional trade hub and alternative routing point for commerce that previously moved through corridors now considered too risky. These shifts are not accidental. They are the predictable economic consequences of sustained regional disruption, playing out exactly as certain governments anticipated they would. What smart capital is doing, right now, serious institutional investors are not waiting for resolution. They are repositioning around the conflict, building portfolios that perform regardless of whether this escalates further or reaches a negotiated pause. Commodity exposure is being increased. Gold, agricultural futures, energy assets outside the immediate conflict zone. Geographic diversification of supply chains is accelerating. Manufacturing relationships that were already shifting away from single region dependency are moving faster than their original timelines. Currency hedging strategies that would have seemed excessive 12 months ago are now being treated as standard risk management protocol. And perhaps most significantly, the business leaders and investors who are navigating this moment most successfully are the ones who stopped asking, when will this end? And started asking instead, what does the world look like if it doesn't? History does not warn people politely. It does not send formal notices. It does not schedule appointments. It does not wait for the right moment to arrive before rearranging everything a person has spent years carefully building. History simply moves. And the only question that has ever mattered in every era of conflict, disruption, and economic realignment that serious students of history have studied is whether a person was moving with it or standing still, waiting for someone to tell them it was safe to act. That question is being asked again right now, and the window available to answer it correctly is narrowing with every rotation of Iran's campaign. The industries, sitting in the direct line of fire. Not every business is equally exposed to what is unfolding in the Middle East, but far more businesses than their owners currently realize are carrying exposure they have not yet identified. The most immediately vulnerable sector is energy-dependent manufacturing. Any business whose production costs are directly tied to petroleum prices, whether through fuel, petrochemical inputs, synthetic materials, or energy-intensive processes, is already absorbing the early pressure of this conflict. They may not have named the source yet, but the cost increases, appearing in their monthly operational reports, have a geographic origin that traces directly back to the Gulf corridors being pressured every morning in Iran's daily rotation. The second most exposed sector is logistics and freight-dependent retail. Businesses that rely on predictable delivery timelines for inventory management, particularly those operating lean supply chains with minimal buffer stock, are facing a compounding problem. Shipping delays from Red Sea rerouting are not one-time disruptions. They are structural changes to transit times that will persist for as long as the security environment in those corridors remains unstable. A business that designed its inventory model around 20-day shipping windows is now operating in a 34-day reality without having adjusted its capital allocation, storage capacity, or customer commitment timelines to match. The third exposed sector is financial services and investment portfolios carrying unhedged Middle Eastern or energy sector concentration. Fund managers, private investors, and business owners with significant exposure to Gulf region assets, whether direct investments, real estate holdings, or trade relationships, are carrying risk that their original portfolio construction did not price in at current intensity levels. The supply chain audit. Every entrepreneur must conduct immediately before any strategic repositioning can begin. A business leader must first know exactly where they stand, and the uncomfortable reality that most small and medium business owners are facing right now is that they do not fully know. They know their direct suppliers, they know the companies they write checks to, but they frequently do not know, with any precision, where those suppliers source their inputs. They do not know which of their vendor relationships carry hidden dependency on Gulf energy infrastructure, Red Sea shipping corridors, or regional financial systems now operating under sustained pressure. This is the supply chain audit that must happen now, not next quarter. Not after the next earnings review, now. Every critical supplier relationship must be examined for geographic concentration risk. Every input material must be traced at least 2 levels deep into its supply chain to identify where regional disruption could create a shortage, a price spike, or a delivery failure that cascades forward into the business. The businesses that conducted this audit 6 months ago are repositioning from a place of knowledge and relative calm. The businesses conducting it today are repositioning under pressure. The businesses that have not yet begun are the ones that will be forced to react in crisis conditions when options are fewest and costs are highest. Currency, hedging, and capital protection. For the entrepreneur operating internationally, or sourcing from international suppliers priced in foreign currencies. The currency dimension of this conflict demands immediate attention. The dollar remains the world's dominant reserve currency. But as part 3 of this analysis established, the quiet rotation of Gulf sovereign wealth fund allocations away from dollar-denominated assets, combined with sustained energy price pressure, creates a currency environment that is measurably less stable than it appeared 18 months ago. Practical hedging strategies available to serious business operators include forward contracts that lock in exchange rates for anticipated foreign currency transactions, reducing exposure to sudden currency movements driven by geopolitical shock. Commodity-linked pricing adjustments that allow businesses to pass through raw material cost increases without absorbing them entirely into margin compression. And geographic diversification of banking relationships, reducing concentration in any single currency or financial system that carries elevated exposure to regional contagion. These are not exotic financial instruments reserved for institutional investors. They are standard risk management tools that serious business operators in volatile environments have used for decades. The barrier is not access. The barrier is the willingness to acknowledge that the environment has changed and that the strategies appropriate for a stable period are not automatically appropriate for the period that has now begun. What history taught the wealth builders. This is not the first time a regional conflict has redrawn global economic maps. When the 1973 Arab oil embargo struck without warning, the businesses that survived and ultimately prospered were not the ones with the most resources. They were the ones with the most flexibility. They had diversified their energy sourcing. Before the crisis made diversification urgent, they had maintained cash reserves that allowed them to absorb short-term input cost increases without being forced into desperate decisions. They had built supplier relationships across multiple geographies so that when one corridor closed, another remained open. When the Gulf War of 1991 sent oil prices surging and regional trade routes into sudden uncertainty, the entrepreneurs who navigated it successfully were the ones who had studied the pattern of how conflicts affect commerce, rather than treating each crisis as an unprecedented and unpredictable event. The pattern is not complicated. Conflict creates scarcity. Scarcity creates price pressure. Price pressure creates inflation in energy and goods. Inflation forces central banks into difficult decisions. Difficult central bank decisions create currency volatility. Currency volatility creates capital flight towards safe assets. Safe asset demand drives gold, agricultural commodities, and stable currency instruments to elevated valuations. This pattern has repeated with variation but recognizable consistency across every major regional conflict of the past century. It is repeating again right now, and the entrepreneurs and business strategists who recognize the pattern early enough are not the ones who predicted the conflict. They are simply the ones who studied history carefully enough to know what conflicts do to economies and acted before the majority of the market caught up to what was already happening. The final strategic warning. Iran's structured daily campaign, the cluster missile architecture that bypassed Israel's defense logic, the dual-front coordination with Hezbollah, the admission from Israel's own government that its alert system is broken. These are not isolated military events. They are data points in an economic story that is still being written. The businesses, investors, and decision-makers who treat them as background noise, as distant geopolitical drama with no direct connection to their quarterly revenue, their supply chain reliability, or their currency exposure, will discover the connection eventually. The only variable is whether they discover it on their own terms, while options remain available, or whether the connection announces itself through a supply disruption, a currency shock, or a cost crisis that arrives without warning, exactly the way those missiles arrived over Israel. At midnight, with no siren, no alert, and no time left to prepare.